If you want to understand the timeline of the coming global conflict, you must stop looking at the movement of aircraft carriers in the Taiwan Strait. Military assets are deceptive. They can be deployed for training exercises. They can be used for signaling, and they can be recalled to port in a matter of days. They are the theater of geopolitics designed to be seen. If you want to know the intent of a superpower, if you want to know if they are truly preparing for an irreversible divorce, you must look at the movement of sovereign debt. Debt is the bedrock of the global order. It is heavy. It is slow. It takes months, sometimes years, to offload significant positions without crashing the market. And when the second largest economy in the world begins to dump the debt of its primary rival at a speed that defies economic logic, they are not rebalancing a portfolio. They are clearing the decks for war. We need to conduct a forensic deep dive into the data released by the U.S. Treasury Department this week. The Treasury International Capital TIC report is one of the most boring, dense, and critical documents in finance. Most journalists skim the headline number. We're going to read the footnotes. The data confirms a trend that Wall Street has been trying to ignore, dismiss, or spin for the last 12 months. China's official holdings of U.S. Treasury bonds have collapsed to $688 billion as of October 2025. To the uninitiated, $688 billion sounds like a lot of money. It is. But in the context of the U.S.-China financial relationship, this number represents a catastrophic collapse. This is the lowest level of Chinese ownership since May 2009. We have erased 16 years of financial integration. To put this in perspective, in 2013, at the peak of Crimea, the symbiotic economic relationship between China and America, Beijing held $1.32 trillion in U.S. debt. They effectively funded the U.S. deficit. They bought the bonds that allowed Americans to buy cheap Chinese goods. It was a closed loop of capital flow that kept interest rates low in global trade humming. That loop is broken. China has liquidated nearly 48% of their position from the peak. They have sold off over $600 billion worth of American IUs. But it isn't just the total amount that is alarming. It is the market context of the recent sales. Throughout late 2024 and throughout 2025, the U.S. bond market was in a historic drawdown. Interest rates were volatile and bond prices, which move inversely to yields, were depressed. Anyone selling U.S. Treasuries during this specific window was selling at a realized loss. In the world of asset management, you do not sell a depreciated asset for a loss unless you're facing a liquidity crisis. You need cash immediately to pay bills, or you believe the asset is about to become toxic. We know China is not facing a liquidity crisis. Despite their domestic real estate struggles, they continue to run a massive trade surplus with the world. They are swimming in cash. Therefore, the only logical conclusion, the only one that fits the data, is that the Chinese Communist Party has made a strategic decision that the U.S. Treasury bond is no longer a STO store of value. They view it as a strategic liability. This is the sanction evasion signal. We must look at this through the lens of February 2022, when Russia invaded Ukraine. The United States and the European Union executed a financial maneuver that shocked Beijing to its core. Overnight, they froze $300 billion of the Russian central bank's foreign exchange reserves. These were funds sitting in Western accounts in New York, London, and Brussels. Russia thought this money was safe. It wasn't. It was seized or immobilized with a few keystrokes. Beijing watched this. They analyzed it, and they realized a terrifying truth. If we make a move on Taiwan, or if the South China Sea conflict goes hot, our U.S. Treasury holdings are not an asset. They are a hostage. The $688 billion they still hold is effectively a donation to the U.S. Department of Justice waiting to happen. The moment sanctions are applied, that money goes to zero. So, they are getting out. They're liquidating the position with extreme prejudice. They are willing to take a 10% or 20% haircut on the face value of the bonds today rather than risk a 100% loss tomorrow. This isn't panic selling. This isn't portfolio rebalancing. And this definitely isn't an accident. What's happening right now will decide your mortgage rate, your stock portfolio, and whether the United States can finance itself after 2026. China isn't trimming exposure. They're dismantling the wall of debt that kept the US economy standing for 20 years. And they're doing it fast. Normally, when a central bank sells, it hides the exit. Slow sales. Small chunks. Quiet execution, anything to avoid spooking markets. That's not what we're seeing now. China shed nearly $12 billion in October alone. Not as part of a long, invisible unwind, but in a single, visible move. That tells us intent. Beijing is no longer prioritizing market stability. They're prioritizing jurisdictional escape. They want capital out of US reach. And they want it out now. That single shift changes everything. For 2 decades, the US ran massive deficits for one reason. There was always a price-insensitive buyer in the East. China didn't care about yield. They didn't care about inflation. They bought treasuries because they had to, recycling trade surpluses back into dollars. That buyer is gone. China has flipped from the largest buyer to the largest seller. And when a buyer that large leaves, you don't get balance. You get a supply shock. So the real question becomes unavoidable. Who funds the US deficit now? Who absorbs the debt China no longer wants? If markets were allowed to clear naturally, yields would already be much higher. And that would be catastrophic. Mortgage rates would spike. Regional banks would fail. Debt servicing costs would explode. But that hasn't happened yet. Why? Because someone else is being forced to step in. Look at the Treasury international capital data. China's line is collapsing towards $600 billion. 2 others spike unnaturally. The United Kingdom. Belgium. The UK's Treasury holdings have surged past $750 billion, placing it nearly equal to China as a top foreign creditor. Pause there. The UK economy is a fraction of China's size. Britain runs a trade deficit, not a surplus. So this isn't excess savings. This is balance sheet stress absorption. Belgium's reported holdings sit between $320 and $370 billion. Is Belgium suddenly rich? No. Belgium hosts Euroclear, the settlement layer of the global financial system. When Belgium appears in TIC data, it usually signals custody, not conviction. And the timing matters. Belgium spikes exactly as China sells. That's not coincidence. That's alignment under stress. Why would rational investors aggressively buy US Treasuries right now? The US runs a $2 trillion deficit. Inflation is sticky. The dollar is openly weaponized. This is not a compelling risk-return trade. Unless the trade isn't voluntary. The implicit message is clear. If China exits and allies don't absorb the supply, the Treasury market breaks. If the Treasury market breaks, the global financial system breaks. This is financial conscription. The periphery is being weakened to stabilize the core. China could buy endlessly because it earned real dollars selling real goods. The UK and Europe don't have that capacity. They're already stretched. If one of them stumbles, as the UK did in 2022, they'll be forced to sell. When that happens, the bid disappears. China understands this. This is a war of financial endurance. Every dollar China sells forces the West to sacrifice liquidity. The US bond market used to be dominated by economic buyers. Now it's dominated by political buyers. Political buyers don't buy forever. They buy until voters revolt or currencies crack. We're watching the shift. From a global reserve asset to a NATO reserve asset. The buyer pool is shrinking. Issuance is expanding. That math doesn't resolve peacefully. China isn't reallocating. They're changing the form of wealth. 4 pivots explain everything. China has been an official buyer for over 18 consecutive months. Unofficially, Shanghai withdrawals suggest much more. Gold has no counterparty risk. No freeze button. No sanction switch. This is a move from credit-based reserves to collateral-based survival. Pivot 2, energy. China imports roughly 70% of its oil, its greatest vulnerability. So it's filling strategic reserves at record pace, often buying from sanctioned producers and bypassing the dollar entirely. Storage capacity is approaching 1.5 billion barrels. This isn't trading. It's endurance planning. China's property sector is collapsing, yet copper imports remain near record highs. That's not construction demand. That's industrial military demand. Power grids. Electrification. Defense manufacturing. They're locking down the physical inputs of future power. China holds 60 to 70% of global grain reserves. Enough to feed its population for over a year without imports. They're trading bond yield for calories. That tells you the mindset has changed. A peaceful nation stores wealth in efficient financial instruments. A nation preparing for conflict stores wealth in inefficient physical stockpiles. Copper pays no interest. Oil costs money to store. But in a crisis, they keep you alive. China is accepting lower returns today to eliminate existential risk tomorrow. That's not miscalculation. That's preparation. This is not investment advice. It's risk recognition. The rules that protected portfolios for 40 years no longer apply. Rule 1: Shorten duration. Long-term bonds are structurally vulnerable. Liquidity beats yield. Rule 2: Follow the physical world. Energy. Metals. Hard assets. China is converting paper into survival. Pay attention. Rule 3: Watch the allies. The pound. The yen. If Japan is forced to sell treasuries to defend its currency, the illusion ends. That's when the Fed intervenes, not because inflation is beaten, but because the market breaks. This is not stability. It's suspension. China is exiting. Allies are absorbing stress. And the proceeds are being converted into assets that survive war. The Treasury market is now a battlefield. The divorce is finalized. We're just waiting for the house to be sold. This is archivist. The protocol is active.